This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
So we're ready to rock and roll.
All right, so we've put together a good little slide deck today. Let's jump in.
We're going to go right to it.
Yeah.
So if you remember, in September 21, we put these slides in What Keeps Us Up at Night. That was at a time when we were talking about the fact that inflation is not transitory. So the few things that power consolidating to the top. So what we mean by this is, again, oligopolies and oligarchs are being created. So the let's say those who have and those who don't, that separation is widening and widening and widening. And that is a concern. You see this happening globally. This is not just happening here in the United States, it's happening across the globe.
Yeah, these seem to be almost longer term trends throughout history, where you have periods where a lot of power is concentrated with institutions or entities or very few people. And then it ultimately some event happens and it
makes it
spreads out to everybody, right? And then it's this pendulum
Exactly.
that swings back and forth. And unfortunately, it seems like we're in one of those
Yeah, we're in a
consolidatory phases.
Yeah, and so, you know, like we might as well just talk right here about civil unrest. When that happens, it becomes highly, you know, what would you say? Just there's just more conflict,
right,
more separation.
Decreases stability.
Yeah,
the more
and
power, wealth, things are concentrated, it also has a negative effect of increasing instability.
Yeah, and we see this, you know, we see more and more incidences of violence here in the United States. And if we continue to see this trend go on, and for those of you who've been with us for a while, no, we've been speaking to this for a long time. Yeah. And there will come a point where it gets, I don't want to say uncontrollable because that's not good, but it gets to a point where it gets worse. And we are definitely seeing that happening more and more. So that's an issue. High debt. So again, this has now happened again, 36 years in the industry. This has just been a continual, slow increase towards debt, going from not only at the individual consumer level, but also at the government level. And that shift was huge during the financial crisis. That's when we really saw this very large pivot of debt from private industry to government. And you'll see we have some slides speaking to this. Why is this an issue? Because high debt ultimately leads to higher prices. So this isn't just a war with Putin situation because energy prices are higher. No, in fact, we'll speak to the fact that that price per barrel is actually lower. This high debt ultimately leads to higher inflation, and that's definitely what we're seeing. And we've been on a spending binge for many years, bailing out.
And looking back at history too, anytime any empire or civilization sort of accrues a massive amount of debt, it ultimately leads to, not saying that that's happening today or tomorrow, but it ultimately leads to their demise. I mean, you know, you can look back at any civilization or empire in history, and ultimately they start racking up the debt towards the last, you know, late stages of.
Think of your own budget, right? If you're just racking up debt, and you can no longer pay your mortgage, well, it leads to the demise of you not having a home. It's literally the same thing at the government level, but it's much bigger. And then supply chain disruption. So, you know, this started supposedly with Corona. We understand that it continued. Now what we're seeing though is it has to do with globalization issues. So what happens in an environment like this is we believe that there's going to be more and more isolationist
Mhm.
kind of attitudes. And you can see right now as the conflict with Ukraine and Russia increases and the US gets even more involved in the process. And now we're also getting involved with issues in Taiwan and China. We are actually pushing China and Russia together, two very powerful forces, right? One thing you have to understand, we depend on China for this computer we have here, for this camera we're looking
It's
into.
all this equipment.
All of this equipment, not just this equipment, but to run our manufacturing plants. There's so much interconnectivity now globally. And as we continue to have, I would say, just our relations with countries around the globe deteriorate, we have to look at how that's going to affect our supply chain.
And moving those supply chains, shuffling them from
Mhm.
China or mostly China to other countries, there's huge lead times. It takes a while to build a large manufacturing factory, especially in a developing country. And then it also adds expense too. It's not cheap.
Yeah.
So when you move from one supplier to another, there's lots of costs involved in that. And where do those costs get passed on to?
Consumer. So this is really important. So the supply chain disruption started with the corona. We weren't getting things in the shipyards. Now we think it's just happening with more and more tension. They're talking about chips, not allowing certain chips to be, to go outside of the United States. So this is only going to send more problems in the future. Stagflation. Many of you will know we've been talking about reverse stagflation for a long time. We think it's here. We think it's here. It's here, whether they want to state it or not. We have a slowdown in the economy. There's no question.
Which we'll show you with data.
Yeah,
right?
We'll show you the moment. And we have a slowdown in the economy, and we have high inflation that's stubborn. And we're calling it reverse stagflation because it's in your necessities.
Right.
It's the things you need. And we're going to show you that. It's the things you need. You can only peel back so much of that.
Right. There's only so much food you can live without, and so much energy, heat you can live without in the cold.
Exactly. So this is what we're calling this time period, Paul and I now. We've come up with our own terms. So reverse stagflation. But now we're calling this the great redistribution. And we think that's what's starting to happen. And it has happened over the last few decades where low interest rates.
Now it's accelerating.
Exactly. And bubbles that bust have basically redistributed wealth from one group to another. And we see that happening now. A great redistribution. In other words, money will be redistributed from even more so from those who do not have to those who do have. And that's at the very high level. So, and then erosions of freedom. We are definitely concerned about some of the talk that's going on right now around our freedoms, around many issues, but we do think that seems to be an issue popping up, and I think more and more people are becoming aware.
Yes, it
of
definitely
these
seems like
issues.
awareness around a lot of
Mhm.
these things is starting to pick up, which ultimately is a good thing.
Well, yeah, definitely for people to get aware, right?
Yeah.
Okay, leading economic indicators.
Right, so first, this is data provided by the NBER. I forget what that stands for. National Bureau of Economic Research. This is government data. That little red line
Right.
is their recession signal. So this organization says, hey, every time our leading economic indicator crosses below this line, it's pretty much a recession that we're headed into. Now, I know a lot of the pundits out there and talking heads have been
changing the definition.
Yeah, right. Not so willing to accept that we are in a recession, but I mean, even looking at a lot of the data, in their official data right here, is pretty much signaling that yes, that's where we are.
And the thing is it's not hitting everyone. That's the thing. So this is when Paul and I are speaking to the separation of those who have and don't. It's not hitting everyone.
Right.
It's now trickled in with inflation. It trickled into the middle class. Now it's in the upper middle class. When you look at incomes, it's definitely affecting. So that's a big shift and change. Where are we next, Paul?
Oh, okay.
Let's
Click. Oh,
okay, here we go.
Okay.
Present
Right, this is also from the NBER, and this just shows it's like a survey of expectations
Consumer confidence.
around consumer
Mhm.
around consumer confidence, right? And since 2018, really, which is interesting, both of these have been declining.
Right. Now that sharp
Hmm.
drawdown was when we were in the
Obviously,
middle of
COVID
Corona.
related.
Yeah.
Mhm.
So that was normal, but yeah. So
Yeah.
it's not at levels that are
We've-
ridiculous, but it's always about the slope of the curve, the direction, which is really important.
Right, and note how none of these, like, there's, everybody was really pretty much post 2009 great financial crisis. The time after that was a nice steady
Mhm.
up in expectations. People really were thinking that, hey, the future is looking really good. Well, what changed in this
Yeah.
period? So,
Exactly. Okay.
so I've seen this
Yeah.
article here.
Spending spree. is
Yeah,
what we're doing.
right. I saw this article. There's a few of these articles floating around. There's one in the New York Times. This one's on NPR.
So this is a mainstream, so
Mhm.
we don't really like to pay attention to
Right.
what the mainstream.
And this is-
So we like
right.
data. This is what
Yeah.
we like right here is what
And
you're seeing.
various different ways to say the same title here, but despite high inflation, Americans are spending like crazy, and it's kind of puzzling. Well,
Yeah.
when you look at the data, it's really not puzzling at all.
See, this is, oh, sorry.
Yeah,
Paul.
no,
You
go
keep
ahead.
going. No,
Yeah.
you're talking about, yeah, it's not puzzling.
It's not puzzling when you look at the data. It all starts to make a lot of sense, almost too much sense.
Yeah, so what you see here is you see credit card debt. You can see this big slope up in credit card debt.
Highest it's ever been.
Highest it's ever been, highest it's ever been. And I hate when that happens, by the way. And then here you see this slight little tick up. So we're just beginning to see some defaults.
30 days overdue, right? So people who are now late on their payments,
For
while it
credit cards.
has for credit cards have
Right.
come down significantly over the past decade, but now it's ticking up again.
Yeah. Now, again, it's about directional, it's about slope, it's all these things. The other thing that we want to say here is what is happening is subprime loans for cars.
Chart.
Oh, you got that chart?
Yeah.
Oh, we have that.
So this was a wild chart that I had saw recently.
Mhm.
New car payments. The share of new monthly car payments that are over $1,000 per month has now hit 15%. It's never been there before in history.
Yeah, look at this curve.
This is
Incredible.
insane. Since
Yeah.
2020,
20.
really, it just
Yeah.
went
Yeah.
exponential almost
Yeah, well, really
Yeah,
here,
yeah.
this is where it really went.
over the past 2
So,
years.
yeah, so the average car payment now is somewhere around
It's
$700
a month, which is
crazy.
just wild because you think about who can afford that, right?
Yeah,
And which
that used to be,
Mhm.
that's what I used to pay for rent.
Mhm.
Yeah, of like a 2 or 3 bedroom condo anyway.
like which demographic or socioeconomic group does that impact the most?
Mhm.
Yeah.
Actually, now that I think about it, that was my mortgage payment in my first
Oh
home.
my,
Yeah,
the same with the car.
yeah. The percentage of borrowers at least 60 days late. So this is what I was starting to speak to is subprime.
Mhm.
So what you can see here is we've had a tick up in defaults in subprime. This is, again, it's not enough to say it's over, but you have to understand, Paul and I take everything together.
It's worth
mean,
paying attention
yeah.
to.
There's more, like, you have to know too, there's more than just what we're showing you here. There's probably about 100 data points
At least, yeah. Mhm.
Okay, so. yeah,
Right, and then this just shows the average prices of items that you really can't do without, right? Things like your utilities or gasoline, milk, eggs, ground meat,
Food,
chicken, bread.
Oops, real
um,
food. Oops. Okay, wait.
They've all gone up. And this is, most recent data here, that the trend is still very much intact for these things for prices to continue higher.
Mhm.
And this is what people need. There's only so much of these items that you can go without.
Right, yeah. So I mean, this for us
It's
is,
concerning this.
yeah, this speaks to that reverse stagflation that we're talking about.
And this data is directly from the Bureau of Labor Statistics.
Yeah, and the big thing is there's only so far you can cut these things, right? From your budget. I mean, you can, in Europe, there are, in Belgium, for example, a lot of people just literally cut off their utilities, but they can because they don't really get worse than 50 degrees generally. Okay, so energy prices. So,
Right.
yeah, you can see that energy prices have come down just, a bit. This is the global price of
It's the
energy.
red line.
Yeah, the red line right here. This is what we're experiencing here in the United
Right. The
States.
blue line is the personal consumption expenditure on energy and energy services. So what you'd want to see is that these two lines
Match up.
should be
Yeah,
closer
see-
together.
See this? They
Mhm.
match up here.
all throughout the
Yeah.
2000 or,
Yeah,
you know, 2010s,
Yeah.
that whole period. When you have these divergences, essentially it's saying that even though the price of energy is low, you're still paying a higher price for it.
Yeah, and you know,
Lower.
lower, right? And you know, we think this is a bit of a head fake, if we're really honest with what we see here, because we believe that right now there's the US isn't the number one in the OPEC. There's a lot of things changing with OPEC and Saudi Arabia right now. So that is something that would affect what you see here, what we see in our prices. The other thing, prices have come down because we've taken from the strategic oil reserve. Okay, so we've actually shipped some of that to China. Now, I know, so
What?
now there is a senator now, I believe there's a bill down there that they're looking to pass around not allowing the administration to take from the strategic oil reserve unless there's a true emergency.
Right.
Because
As
that's what it's there
it-
for. It's for a true emergency. So let's see. Next one, retail sales. So this is what Paul was speaking to earlier. You see the spending is higher. So
Yep.
there's.
So you see this sort of like forced drop was basically when, you know, the world or United States was shut down. So it was a forced stop in sales that happened because of that. Then there was a whole bunch of stimulus. And you can see that, like, yes, lots of spending, but really since January last year, it's essentially been flat.
It's
so
flat.
It's not that people are out there spending on whatever they want, you know, retail wise, frivolous consumption or just for fun. This to me tells that story
Of the previous chart where you saw the spending going.
right, that we're spending on the necessities.
Right.
We're spending on the necessities. And
Because the headline is saying people, if you read just the headline, this is why I don't even like to even look at the newspaper because it actually drives me crazy. But you look at the headline and say, oh, whoa, people are spending more than before. Well, of course, because they're paying more.
Yeah.
It's awesome. All right.
And
so-
then inflation in general is, yes, it's come down because the price of energy has come down, but it's still greatly elevated from where it was in the past. So yes, of course, things are still more expensive.
All right, corporate profits.
Wanted to throw this in
This
there.
is not uncommon. When you see a spike in inflation, it's not uncommon to see a spike in earnings. You can actually see it. You can't really see it well, but in 1975, if you might,
If only we could zoom in
yeah,
there,
if we can
yeah.
zoom in, you can see this was actually a pretty significant rise in corporate earnings, because the expectation is that people are expecting to pay higher prices.
Mhm.
And for a while, it is sticky. It can be very sticky. And so this is what we see here for sure is these corporate profits
Yeah,
up
it's
significant.
concerning.
Mhm. Yeah, that's amazing.
Mhm.
Okay, so this
Yeah.
is, this is the redistribution we're talking about. You see here, now you can see our debt.
Right. These charts look small. On the left, we have federal debt as a percent of GDP since 1940. And on the right, we have just the total debt in dollar terms since 1922.
Mhm.
And you can see 124% is our current debt to GDP ratio there. Highest I mean, I guess it was a little higher last year or so, but
Mhm.
Still in new territory, essentially. And we're sitting on $30.9 trillion in debt. And
It's greater than our GDP. So that's that's significant. And that's inflationary. So you know
Right.
that is an inflationary pressure.
Right. Yeah.
Mhm.
That's a lot of
It
debt.
is.
Where does it come from? I mean, how do you pay that off? Right? Where you're the assumption,
Taxes.
right? The assumption
Yeah.
is that future growth
Mhm.
will eventually catch up.
Yeah, if
And-
future growth picks up, you know.
But
so-
will it when we look at global demographics, the fertility rate has dropped to,
Mhm.
we can get into that later.
Yeah, we can, that's going in the notes, but yeah, the debt is, I mean, this is astronomical, what we're
Right.
looking at in terms of.
So we
our
were just looking at the
indebtedness.
US, and now this chart shows the world.
The world. Mhm.
You know, almost $300 trillion in debt. The world average is saying it's 350 or so higher percent of global GDP. So what that's saying is for every 1 unit of GDP that is created,
Yeah,
it takes
there's
3.5
times.
units of debt to get there.
We're on a drink.
Does that sound sustainable?
But you know what, this is the funny thing, because I've been saying this for forever. I was saying this when debt was in this level here, and I'm saying, my gosh, like, how are we gonna keep up with this?
Mhm.
So, well, we did, so,
Professional can kickers.
yeah,
for
okay,
now.
deglobalization.
So right to our
Yeah.
point on supply chains and issues happening in globalization,
Mm.
you can see there's different eras that have, this is an interesting chart that shows, when globalization is happening and when the sum of imports and exports switch, and it's essentially moving towards a more
Isolation,
isolationist
yeah.
approach.
isolation.
And really since
That's like 2010.
10-ish or
Yeah,
so,
yeah.
it's been relatively flat. There hasn't been
Yeah, I mean,
Yeah.
there was just a really large push
Mhm.
towards globalization back, in 2000, right? And
Mhm.
now it's just, we're seeing a completely different
Right.
communication.
This chart also, it takes a little explanation here, but it also shows on the black line shows from 2009 how much investment went from developed economies into emerging
So
economies.
yep, the higher the line here,
And-
more has
and-
gone to
right.
emerging
Mhm.
economies.
And how many years after, how much went.
Yeah, from 2009 to forward,
And so-
2009 basically to 2014. And then here you see,
From 2020 until today
Mhm.
is a much less, we're always talking about slope of the curve, is
Much
a
less.
much more flattened slope,
Investment.
saying that there's comparatively way less dollars flowing
into emerging.
for
economies.
investment into those economies, right? So,
And that makes sense, given
Mhm.
everything that's transpiring at the moment. Okay, so let's see. Freedom index.
yes, this is a really interesting, it is subjective, so
Mhm.
I'll just throw that out there, but it shows, based on a whole bunch of different metrics that track property rights to local elections, government integrity, tax burdens,
I really like this chart.
government spending, fiscal health, all these different metrics on all different types of countries around the world. And what we found really interesting is that there's a trend in the United States since about 2006 or 7 or so, where this has slowly been decreasing,
Mhm.
which is concerning.
Mhm. Yeah, and then this is the rest of the world, which is generally stable, but
But
really,
lately, right,
since-
there's a
since-
change
yeah.
there. So
Yeah.
we'll see
So
how
this
this
is
plays out.
a ton of metrics here,
Mhm.
which I like this chart. I think that's the last one, is
There's
it?
one more.
Oh, there's one more. Oh,
Yeah, and just
reg-
one more,
budgets.
right, on regulation, talking about freedom. You can
Mhm.
see that, regardless of president,
Doesn't
the
matter.
rules that they're putting in place have been on this trajectory
Mhm.
upwards. So
Mhm.
more and more rules, more and more regulation, and some regulations great.
Yeah.
Some is necessary and
Mhm.
some is needed, but that's, you can get real into the weeds there.
Mhm.
But what we found really interesting was the budget that are associated with these agencies has
Increased exponentially.
Yeah.
Like, this is the
Wow.
budget. Look at this. Look at this. Look at the budget.
I mean, almost
See,
the
that's
10x
the
over the past 40 years, right? Mhm.
Economic, it's crazy.
Wild.
I mean, that's runaway, if you ask me. Somebody needs to do something here. All right, let's see what we have for questions here. And we have a couple right here.
Yeah.
Oh, that's odd. I don't know why was he removed? Do you know why? he
I
was-
don't know.
No, it wouldn't be our system that would remove him, right?
Sounds like whoever this was able to get back in.
Okay,
good.
yeah,
Okay.
yeah.
All right, can you show corporate profits?
Yeah, we'll show the corporate profits again.
Sure.
And the question was, will you show corporate profits again? There you
So
go.
here's that chart. That red line sort of is the average
Mhm.
based on its just the overall curve, way above the mean.
Mhm,
Usually that means mean reversion is in the cards, but as
mhm.
far as timing, nobody knows.
Yeah.
Um,
Okay, so what else do we have here?
So what do you think about corporate profits going into end of 2023 and into 2024?
Okay, so one of the things that we want to say is, you have to know when there's high inflation, there's usually like a big push. If some of you remember the 70s, maybe I do really well. You would go to the store one day, the next day you would go and you would see prices up exponentially. Companies know this, they benefit from it. And you're seeing that happening. You're seeing it in the airlines. So like during Corona, the airlines became more efficient. Basically, they deleted some of their routes, or at least took them out for the time being. And now they start to fill up their planes, and now they're getting higher prices, fees. Now you have to actually pay for your seat.
Always with the fees.
It's always with the fees. By the way, those fees don't necessarily get counted towards inflation. So they'll look at the price of a ticket, which gets counted towards inflation, but not the fees. So we now know you get fees to pick a seat. You get fees if you want to take a carry-on. Now, some airlines, if you want to take a carry-on and a checked bag. So those don't get counted. But to your question about where we see profits going in the next quarter, eventually these companies are going to be up against higher costs themselves. And there will come a point where the consumer will not be able to absorb what's there. So, you know, what we see going forward, I think that we'll see a squeeze. Yeah.
Okay. Let's see, so indemnification insurance rates.
I don't know that one. There's a question here from someone that I can be on anonymous, and I could not actually answer that question. You know anything about that?
So would investments, certain companies or investment funds be impacted by higher rates on ocean cargo vessels? So basically the cost of transportation. So if the cost of transportation increases, yes, that will be passed on. One thing we are seeing though in a lot of the global transportation is that prices went up so high for cargo that there is this mean reversion where they are coming down, but they still are, you know, 2 to 3 times or maybe even 4 times in some cases higher than where they used to be several years ago. So if those insurance rates keep going up, it's just one more cost that gets
specifically to investment funds. So I
in terms of individual funds, we won't go there. You can give us a call later, you know.
It maybe be more specific about what you're looking for there, because we're not so sure. You're talking about specific investment funds for that industry.
This recording will be
yeah, it's available.
Yeah, it will.
Yep. We always have to
we'll post it on our site in about a week. Okay, something on NAFTA.
Yeah, so the question is here is because of the war.
Agriculture.
Yeah, it's another question around agriculture that we got, and we'll address it here. Where do you see the ag sector going with fertilizer and cash crop disruptions of the war in Ukraine and sanctions? So, you know, first of all, you know that fertilizer prices have come down. It's such a cyclical industry.
Yeah,
I do think overall we're having issues in our ag sector. And I'm not sure all of it is market driven, and maybe not so much, and maybe more policy driven.
Yeah, a lot. What's crazy too is a lot of the inputs for fertilizers are from Eastern European countries, right? So like Belarus and some of these countries are the main exporters of. I don't want to misspeak. I just read a chart, and I think it was ammonia or key ingredients to creating these fertilizers. And so as long as disruption continues in those areas, it's going to be a problem.
Yeah, I mean, we do see that, again, we do see that the prices have come down a little bit in like, for example, some of the potash and such like that. The bigger concern, well, it's not that the conflict isn't a concern, it's also a policy concern around our agriculture. It's definitely a concern.
Policy is huge, right? Global supply chain disruption is huge in this. The raw material input costs are a huge thing. It's one of the issues with a global global economy that depends on these things, things so much.
Yeah, and there's a move, you know, just in the ag sector will just be, there is a move here to lower carbon emissions, quote unquote. So, for example, the farmers, if anybody's been following the story in Holland, I think 4,000 farmers have been demonstrating, because essentially they're being told that they can only grow 2 crops as opposed to what they typically grow.
And at end of the day, it limits consumer choice
It's-
and
it's not
puts more
sensible.
cost on you.
And us, on the
all of us,
consumer.
right?
So I'd say that's more of a concern to me about what's happening in agriculture is like what policies are being put in place and what's being forced on these farmers right now. And yes, if there's more disruption in the eastern part of Europe where we do get a lot of fertilizers, yes, there will be more problems. You think?
I do remember seeing a chart too, showing price of fertilizer coming down, but it's still 2 to 3 times more expensive than it was, 3 years ago or so.
So the other
That'll probably stay
Yeah.
at that level.
So the other question somebody asked is, sorry, Paul,
Yes,
presumably the Fed is going to be lowering rates in the near future. Look at, we have a take on this. The street has, first of all, you have to remember in 2021, everyone said that inflation was transitory. We said it wasn't. It's not. Here we are in 2023. The Fed has done a tremendous amount of rate hikes. We've read a lot in the newspaper, people calling for the Fed to lower rates soon. They're going to slow
Fed
down.
pivot, right?
The
Yeah.
Fed is going to pivot. This has been in the mainstream media, but then in the last couple of weeks, is it, Paul? We got our inflation number, which was higher than expected.
Mhm.
At the producer price level, it was much higher than expected.
Right.
And then there was a print on employment that showed it was higher than expected, which we, questioned the viability of
Yeah.
that report.
Official employment data, I would be highly
Suspicious.
skeptical.
Yeah, because
Yes,
there's so many
suspicious
ways
of
that they
it.
can
Mhm.
categorize things. So that's there. So to your question about, are they going, they're presumably going to lower. Even though the curve is inverted and would suggest that they would, because we're headed for a recession, that's what an inversion shows. The Fed has come out and begun to speak again about how they have to be more hawkish on rates. So the last minutes, they said that they could slow down, and then in their most recent conversations, when they're out speaking, they're talking about having to be vigilant about inflation. So I'm not willing to make a guess
Mhm.
to the fact that they're going to stop at this point.
It's too early to tell at
And-
this point.
And so somebody's asking about where to invest the long term. There, despite what's happening, there are areas in the market that are doing okay. Like some of the emerging economies do look good to us. Some sectors do look decent. Some stocks have hit pretty low valuations. So it depends upon what they're
Right.
looking
There's a
for.
lot of potential out there
Yeah.
right now, but it's not prudent to jump into all these things, I would say, yet, or maybe ease into something. But
Yeah.
at this stage, a lot of this data we're looking at, it just paints a
It's so
concerning
crazy.
picture.
It's crazy because we want to be fully invested in the market, and yet day by day we see things creeping in showing us to continue to stay conservative. So long term, what do we like? Of course, we like growth stock. We like to be in markets long term, but then there are times where you just have to be.
There's a lot of cool stuff going on in the tech field, but I would say it's not yet the time to get in there. But long term,
Yeah. So what other questions do we have? Oh, yeah. So I think we wrapped it up. There was that one question that somebody had with regard to NAFTA, but you might want to just text us, email us directly on that. So the takeaway here is there are some good valuations in the market. We do see certain sectors starting to shape up. This is the first time in a while. We do also have some, I would say, concerns about whether the Fed is going to raise rates. I think you can see that the markets are captive to the Fed, and therefore we have to pay attention. Now, what we do see is that the curve is inverted, which would say we're headed towards a recession, which would ultimately mean that the Fed would eventually lower rates. And that's what Wall Street, that's why it rallied this year, because they're thinking, oh, the Fed's going to
they'll
stop.
just cut and risk back on and free money, cheap, easy money everywhere, and we can continue the party.
Yeah,
Uh,
and we're really not so sure that that's going to be the case. And here's the thing, in my opinion, I can't speak for Paul, but if the Fed were to, continue to raise rates rapidly, last year they raised very rapidly. It's almost like, are they trying to break this economy? Because
it makes you wonder.
yeah,
That
because there's so much debt that would be reset, and that the reset could create some problems in payment.
Yeah.
So
we'll see.
anyway, okay,
All right.
I think that's it.
Well, we'll have a recording of this posted on our site, investwithwillow.com, in
Thank
about
you.
a week or so. In the meantime, if you have any questions, feel free to reach out to us directly. If you have any feedback or any direction that you would like us to go in future presentations, please let us know. We're more than happy.
Yeah. And if some of you want any of the slides, let us know, because then we can get it to you, because then you can see it a little bit better.
Perfect.
Okay.
All right.
All right, thank you.
Thank you.